Module 6. More business entities. Limited partnership. A limited partnership, or LP, is a type of partnership that consists of one or more general partners and one or more limited partners. The general partners have unlimited personal liability for the partnership's debts and obligations. In contrast, the limited partners have limited liability and are typically not involved in the day-to-day management of the partnership. The general partners manages the partnership and makes all business decisions. They also have personal liability for the partnership's debts and obligations, meaning their assets may be used to pay off their debts. As a result, general partners often have greater control over the partnership. The limited partners are passive investors in the partnership and do not have a say in the day-to-day management of the business. They contribute capital to the partnership but are typically not personally liable for its debts and obligations beyond their initial investment. Limited partners are often attracted to LPs because of their limited liability protection. Limited partners have no personal liability beyond the amounts they invest in the partnership and no active role except as specified in the partnership agreement. In terms of taxation, LPs are typically taxed as pass-through entities. This means that the partnership's profits and losses are passed through to the individual partners, who report their share of the profits and losses on their tax returns. LPs are often used for investment and real estate ventures, where the general partners manage the business's day-to-day operations. In contrast, the limited partners contribute capital and have limited liability protection. LPs can be a good option for individuals or groups who want to invest in a business or real estate venture but want to avoid the entire risk of unlimited personal liability. Calculating the balance of a partnership capital account. The balance of a partnership capital account represents the amount of money each partner has invested in the partnership and any share of profits or losses allocated to them. To calculate the balance of a partnership capital account, you first need to determine the initial contribution made by each partner. This can include cash contributions, property or assets, or services performed for the partnership. The initial contribution is credited to the partner's capital account. Next, you must track each partner's share of profits and losses. This is typically done annually and is based on the partnership agreement. The allocation of profits and losses can be based on various factors, such as the percentage of ownership or the level of involvement in the partnership. Profits are recorded as a credit to the partner's capital account, while losses are recorded as a debit. Finally, it would help if you accounted for any additional contributions or withdrawals made by each partner during the year. Additional contributions are recorded as a credit to the partner's capital account, while withdrawals are recorded as a debit. Once you have accounted for all of these transactions, you can calculate the balance of each partner's capital account by adding up the initial contribution, the share of profits or losses, and any additional contributions and subtracting any withdrawals. This will give you the current balance of the partner's capital account at the end of the year. It is important to note that the balance of a partner's capital account does not represent the actual value of their ownership in the partnership. Instead, it is a running total of the partner's contributions and share of profits and losses over time. If the partnership is liquidated, the partners will receive a distribution of their assets based on the partnership agreement, which may or may not be proportional to their capital account balances. For example, assume Foreman and Barry are forming a partnership. Foreman will invest in a building currently being used by another business owned by Foreman. The building has a market value of $80,000. Also, the partnership will assume responsibility for a $20,000 note secured by a mortgage on that building. Barry will invest $50,000 in cash. For the partnership, the amounts to be recorded for the building and Foreman's capital account are building, $60,000, and Foreman, capital, $60,000. When Foreman contributes the building to the partnership, the value of the building recorded on the partnership's books will be the fair market value of $80,000. However, since the partnership is assuming responsibility for a $20,000 mortgage on the building, the net value of the building is $60,000, $80,000 minus $20,000. Therefore, the partnership should record the building at $60,000. Foreman's capital account will be credited with the net value of the building, which is $60,000. Barry's capital account will be credited with the $50,000 cash investment. Therefore, Foreman's capital account will be $60,000 and Barry's capital account will be $50,000. Mutual agency. Mutual agency is a legal concept that applies to partnerships and other business organizations where two or more individuals work together to conduct business. In a partnership, mutual agency means that each partner has the authority to act on behalf of the partnership and bind the partnership to contractual obligations. Mutual agency implies that each partner in a partnership is a fully authorized agent of the partnership. A partner may be able to legally bind the partnership to actions even if the other partners are unaware of his actions. This means that each partner can enter into contracts and make decisions on behalf of the partnership, and those decisions are legally binding on all partners. This is in contrast to a corporation, where a board makes decisions of directors and officers, and individual shareholders do not have the authority to act on behalf of the corporation. The mutual agency also means that each partner is responsible for the actions of the other partners. If one partner enters into a contract on behalf of the partnership, all partners are responsible for fulfilling that contract. Similarly, if one partner engages in illegal or unethical behavior, all partners can be held liable. It is important to note that mutual agency can be a double-edged sword. While it allows partners to act quickly and decisively on behalf of the partnership, it also means that partners can make decisions that may not be in the partnership's best interest. Those decisions can have severe legal and financial consequences for all partners. Therefore, partners must establish clear decision-making guidelines and procedures and communicate effectively to avoid misunderstandings and disputes. Statement of cash flows. Non-cash investing and financing. The statement of cash flows is a financial statement showing the cash inflows and outflows during a specific period, classified into three sections: operating, investing, and financing. In addition to the three main sections, the statement of cash flows also includes a section called Supplemental Information, Non-Cash Investing and Financing Activities. This section reports significant investing and financing transactions that do not involve the use or receipt of cash. Examples of non-cash investing and financing activities that may be disclosed in this section include acquisition of assets by assuming liabilities or issuing equity securities, conversion of debt into equity, exchange of non-cash assets or liabilities, retirement of debt by issuing equity securities, and acquisition of an asset by entering into a capital lease or similar arrangement. By reporting these non-cash transactions in the statement of cash flows, users of financial statements can understand the company's investing and financing activities beyond what is reported in the main sections of the statement.